trade deal that we have seen is something that is positive for sentiment, but has very little implications in terms of a change of trend in the global growth. Fundamentally, because if you look at the deal, most of what China is going to buy from the United States, added to what they already acquire, is goods and services that will be less imported from other countries. So, for example, the European Union, Brazil, Qatar, countries like Argentina will be exporting less to China so that China can buy from the United States those $200 billion of additional goods. I think that therefore the change in global trend is going to be very limited. But I also think that the key factor is not this phase one deal, but the next one, the phase two. And I think that that is going to be much more difficult to achieve. So we need to be at least prudent. This is good for sentiment. It is also good in the sense that it lifts a lot of the concerns about the relationships between the two largest economies in the world, but it's going to have very, very little impact in terms of global growth. Well, the European Union economy has stabilized and the UK economy as well. And I think that those two factors are already positives. I think that the worst case of the Brexit scenario that were considered at the beginning of the last year as one of the biggest threats to the economy of the European Union and also to the economy of the UK, the worst case has already been out of the picture, which is a great thing. We don't consider the risk of a hard Brexit, and we don't consider the risk of an escalation in trade disputes between the UK and the members of the Eurozone. So that is a positive element. What I think is a challenge is to see the trade deal being implemented very quickly and a swift and efficient agreement being implemented rapidly. Therefore, we need to be slightly prudent, but at least definitely, what we can be extremely confident about is that the risk to the currencies and the risk to also a perception that the economies could go into a massive recession because of the Brexit concerns, those two factors have been erased, at least from the market mind. Well, the British economy has a lot of cushions and it has very, very low unemployment. And I think that one of the positives is that from a very low level of unemployment and very controlled levels of inflation, the UK economy can recover very rapidly. If we saw the latest GDP figures that were a little bit disappointing, they came fundamentally because of the risk of an aggressive Brexit or a result of the elections that could have been very negative for the economy. I think that both those things are out, and now low unemployment and an improvement in gross formation of capital, foreign investment, and consumption is quite likely to happen. So I'm quite confident about a recovery both of the Eurozone economy and the UK economy. However, both without expecting them to grow dramatically higher. So still subdued levels of growth. We cannot expect them to grow 3-4 times the level of GDP growth that we saw last year, as some of the most optimistic consensus estimates are expecting, no? Well, the ECB is likely to maintain a very, very dovish, very accommodative position in terms of monetary policy. I think that Ms. Lagarde, the new president of the ECB, has already mentioned a few times that she aims to continue to have very low rates and to continue to purchase about 20 billion of bonds every month. The question mark on the ECB policy is whether this is working. And I think that the risk of maintaining a very, very aggressive and dovish position from the ECB is that we end up in a situation in which there's a massive level of liquidity, very low rates, but growth doesn't improve. So currently the ECB policy is helping a lot of sovereign states finance themselves extremely cheaply. And that is a risk, obviously, because it can generate, let's say, a level of complacency that we are seeing in some of the peripheral states, that they believe that those low yields come from the policies of governments instead of monetary policy. So the ECB has to be very, very careful about the risk of entering into a Japanese situation of stagnation, and very careful about keeping a very aggressive monetary policy that ends up having very weak returns, if not diminishing returns. Well, the global outlook for the economy globally is of weak growth, weaker growth than we have seen in the last 15 to 20 years as an average in periods of, let's say, not recession. But what I think is different is that the probability of recession, that was something that everybody, or at least in the markets, was something that was commented constantly. I think that the probability of recession is probably lower. However, what I think is that the expectations of a more robust level of growth, expectations of a big changing trend, are very optimistic. So if you look at basically the large economies, the United States is expected to grow slightly below 2%. The US economy is going to help some of the Latin American economies to grow around 1.5% to 2%, but not a lot more. And if we see India, I think around 5.2%, China around 6%, and the Eurozone a little bit below estimates, around 1.1%. So again, what we're talking about is going back to the concept of very poor levels of growth and very indebted levels of growth, but so far the signals of recession remain weak, at least. But we need to monitor things like what is going to happen with interest rates, and what is going to happen, obviously, with the large levels of maturities of foreign exchange debt that are coming in 2020 and 2021. So all in all, I don't think that we can expect the global economy to grow aggressively, and I don't think that the trade deal is going to make global trade growth improve significantly. However, I also think that on the positive side, the signals of risk of massive recession, or the signals of risk of a sort of domino effect crisis, are quite limited.